Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today in the EIA show, we're just going to go through our overview and we're going to tie in some of the impacts from Hurricane Laura, what is residual and what do we expect over the next coming weeks. Then we're going to follow up with a bigger focus with you on refining and then wrapping up with exports. So just getting right to it, we're going to jump right in with you on the hurricane and really what is the fallout. So here you can see, just based on the most up-to-date information, we have about 525,000 barrels a day of oil that's still shut in, or about 28% of Gulf of Mexico production, about 25% of gas, which is about 677 MMCF a day. So those are the impacts that remain based on what the issue were, and then what is the residual. Now, the storm surge wasn't as broad as expected, but it was still significant in some specific areas, Lake Charles, Calcasieu, and those are going to remain a problem. So right now, there's about 11% of the platforms in the Gulf that remain offline, just because they're either still shut down, still going through their checklist. And there you can see, just based on some of the temporary offline, by those, let's call them brown or tan dots, you can kind of get an idea of what is some of the residual that will be coming on over the coming few weeks. And typically, we should see some of this come back over at least over the next 10 days. But when we go through in the next couple slides, we'll talk about the refiners and what refiners remain offline, and how some of that will remain relatively sticky as we go through the remainder of not only September, but then what do we look like going into October. So, like we talked about last week, we expected a crude draw. It was bigger than what we were expecting, and it really comes down to a multi-level or layer of some of the issues that were impacted. So we always talk about the SPRs, so keeping consistent. We had a draw of about 10.67 million barrels a day, and it was really driven based on we had a big drop in imports, and we had a big drop in production, and we had some refinery utilization that was a little bit sticky and didn't shut down in the same way. So there was a lot of timing delays, and this really led to a bigger draw than what was expected. Now, this is something that will start to adjust itself, especially as we go further into post driving season, which will end this weekend, with this weekend being Labor Day. So Labor Day, we're expecting to see a little bit of a surge in gasoline. Question is going to be, what does that demand look like? And then how does the residual continue as we head into typical shoulder season? So here you can see that the biggest drawdown was Pad 3, 8 million barrels. And again, that comes down to that timing delay with the hurricanes and whatnot. So just kind of jumping in, we should expect that on a production level, that million barrels or at least 800 to 900,000 barrels start to adjust throughout this week. So we should get back to at least about 10.5 to 10.7 over the remainder of the week, and then that'll help for next week's numbers. And here you can see just the drawdown when we're starting to factor in the DOE crude totals, and it's important to calculate and roll in the SPR, just because the SPR it has storage starting to come out, and there was some damage that was experienced with the SPR, which will also take some time. But again, those are things that shouldn't really matter, because there's other sites which they can pull from in order to recover some of their crude. So we still will continue to see the SPR draw down over the next 3 to 4 weeks. Now, the bigger component is going to be Pad 3. How quickly can we see some of this reverse? And the reversal will really come down with the refiners staying offline, some of that production and imports starting to normalize, and that will really kind of offset. We'll start to see some builds, a lot of really make up for what we lost here, but also continue to build what we think is going to be a bit above the seasonal norm as we go through the remainder of September. And understanding the dynamics is important. So here you can see that on an import level, we lost about 1 million imports a day. About 500,000 came from Pad 3, but we also had a big drop in Pad 5. Now, if you remember, Pad 5 had a big step up in imports. Again, these are all going to be timing delays. And it's so right here, we expect to see an increase in Pad 5, but again, it's not going to be to the same level because we did have a big surge. Pad 3 will start to adjust, and that'll just come down to how quickly can the ships come back in, because we had about 80 some odd vessels that scurried away to avoid the hurricane, and then some of the ports remained closed at specific areas because they were picking up and I think there was several docks that sunk. They had to clear some of the debris, making sure it was safe to traverse. So those are, again, things that just take time to adjust. The runs, we can see that we were down about a little over 5% at about 76.7%. The big drop now, Pad 3 recorded about 859,000 barrel decline. We know that about 2.9 million ended up coming down in total, but we did have some of those refiners turn back around. So right now we still have, let's say, about 1.8 million, which is still down, but operations are starting to normalize. So just to give you a breakdown of who, we have Citgo, which is 425,000 barrels. That'll be down for about 4 to 6 weeks, depending on what kind of damage there was. They're still getting electricity. Some of these areas still don't have the right power. And what do you need more than power to keep some of these operational? Total's facility of 225,000 barrels, Phillips 66 of 249, Motiva of 607, Valero of 335,000. And now those are the ones that remain down. But now we have an Exxon Beaumont, which is starting to come back. That's 366,000. And we have Chevron restarting, which is 110,000. So we have about 1.8. Now, by the time we get to next week, we should see about 900 to 1 million barrels of that come back around. So we should see some of that disconnect start to get closed. But so you can see we didn't. This didn't pick up the full down, the full down move. We won't pick up the full up move. And the question is, how much of it's going to stay down? Now, we know that there were several facilities that were already planning on shutting down in September. So we just won't see a lot of this reaction. So we'll see about 900,000 barrels a day, about, let's should say 700 to 900,000 remain offline, just given where we sit in not only the demand cycle, but also just the seasonal cycle. Now, when we go to implied demand, again, implied demand is a calculated number, lumpy. You can see that it was hit across the board. This is really what we were talking about last week, where it's a timing delay. It's a matter of, we saw 2 weeks of declines in gasoline demand, not only at the pump, but the rack. But we were still backfilling in terms of the gasoline side. Now that is starting to normalize. We'll start to see that come down. We should see another little pickup just because there's an expectation of Labor Day, some increases in demand. So that'll remain fluid, but again, it's going to start rolling over. Distillate is again, we've talked about being relatively flat, kind of bumping along the sides. And then obviously jet fuel faces additional headwinds as we go forward. So looking at floating storage, now the way the calculation is worked, it's any vessel that hasn't moved in 7 days. And now we know that a lot of vessels moved over the last couple of days because they had to get out of the way of the storm. So technically, this is showing 0. And again, it's still at the extremes. But when we look at the ships moving back into place, you can get an idea of the amount of vessels that are still in the market. So even though on a calculated number, it looks like we don't have floating storage, but we really do have a significant amount of crude. It just doesn't meet the definition in terms of a lot of them moved. And as you can remember from last week, when we had the path and then you had all the ships that had moved to the south, I should say the southwest, now they're back and getting ready. Now the pilots are still a little slow to getting things back just to make sure of safety, but this is something why you're going to start to see those imports pick up. And just on timing delays, you're going to start to see some of that floating storage get populated through the remainder of this week. And here is just something that shouldn't be surprising in terms of just where we lost a lot of imports into Pad 3. This is something that will start to reverse. And again, it's not going to reverse on a huge number just because we were already trending lower. And as we go into the seasonality side, you're going to see a lot of this remain off. But again, this will start to reverse, and this will help kind of close some of the gaps that we've seen with the drawdowns in Pad 3. Now, when we look at the utilization refinery side, you can see the sharp move. And if you look back in history, when we consider what happened with Harvey, there was a sharp move down, and then there was another move down as some facilities were taken down for additional maintenance, for power issues. The power issue will remain consistent. We should see about 2 facilities that are going to account for about 700,000 barrels that will stay offline, just in terms of going through their checklist to make sure that we're starting to see some normalization. And again, this is just going to be a timing delay. So we don't think you're going to really get back to that 80. It's going to be more now hanging around the 77, 78% utilization rate, which we think will start to trend lower, especially as we start going through and heading into a deeper shoulder season with distillate, with gasoline levels at these elevated, at just the elevated side of the storage equation, which is going to put pressure on pricing, as we continue to see on crack spreads, on just inherent refinery margins, which is something we're going to go in more depth in our next segment.